There is a number hidden deep inside the financial statements of every publicly traded company. It's not the number you read about on the front page of the Wall Street Journal. It's not the earnings per share figure that gets blasted across cable news every 3 months. It's not revenue, it's not net income, and it's not the profit margin that most analysts obsess over. This number is quieter, more subtle, but it tells a story of such profound importance that for a small group of the world's most successful investors, it is the closest thing to a financial oracle that exists. This number reveals the true nature of a business. It separates the companies that are built to gush cash from those that are designed to consume it. It is the architectural blueprint of a compounding machine, the genetic code of a true financial fortress. Warren Buffett didn't discover this number in a textbook. He learned it the hard way through a painful and expensive evolution that took him from being a statistical scavenger, a buyer of cheap and broken businesses, to becoming a connoisseur of quality, a partner in the world's most magnificent economic castles. This journey, and the powerful metric at its heart, is what we are here to explore. We are going to deconstruct the single most important principle of quality investing: return on tangible capital employed. This isn't just an academic exercise. This is a fundamental shift in perspective, a new lens through which you will see the entire landscape of business and finance. By the end of our time together, you will understand why a boring chocolate company can be infinitely more valuable than a futuristic airline, why a simple credit rating agency is a better business than a massive car manufacturer, and how you can use this one metric to avoid the costly market mistakes that trap 99% of investors, and instead, identify the capital-light, super-efficient businesses that are the true engines of long-term wealth and financial freedom. This is the key to understanding the difference between a good business and a great one. This is the secret to real profit. The story of this profound transformation in investment philosophy begins not in a gleaming Wall Street skyscraper, but in the sun-drenched landscape of California in the early 1970s. Warren Buffett was already a success, a financial prodigy who had spent 2 decades perfecting the art of cigar butt investing, a methodology he learned at the feet of his mentor, the legendary Benjamin Graham. The idea was simple and potent. Find a company trading for so little that it was like finding a discarded cigar on the street with one good puff left in it. You didn't care about the quality of the cigar, the brand, or its future. You just wanted that one last, free puff. You'd buy a struggling company for less than the value of its working capital, sell it for a small profit when the market corrected, and repeat the process. It was a gritty, quantitative, and profitable game. But his partner, Charlie Munger, a man whose mind moved with a different kind of electricity, was beginning to plant a seed of doubt. Munger argued that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The cigar butt approach was laborious. It required constant turnover and it was not scalable. You could make millions, but you couldn't compound billions with it, because you were constantly buying and selling junk. The real money, Munger insisted, was in owning a slice of a truly exceptional business and letting it work its magic for you over decades. In 1972, this philosophical debate took on a tangible form. A company came up for sale, See's Candies. On the surface, it looked like the opposite of a Buffett-style investment. It was a beloved, family-owned chain of chocolate shops, primarily in California. The asking price was $30 million, which the seller later dropped to $25 million. Buffett's cigar butt brain immediately recoiled. The company had tangible assets, things like inventory, receivables, and equipment, worth only about $8 million. To pay $25 million was to pay a massive premium, a $17 million price tag for something he couldn't see or touch on a balance sheet: the brand, the customer loyalty, the reputation. This was goodwill, and in the world of Ben Graham, goodwill was a speculative phantom, a dangerous fiction. Buffett was about to walk away. But Munger was insistent. He pushed Buffett to look deeper, not at the numbers on the page, but at the economic reality of the business itself. What did he see? He saw lines of customers stretching out the door at Christmas and Valentine's Day. He saw people who, having moved away from California, would pay exorbitant shipping fees just to get a box of See's. He saw a product that evoked powerful, nostalgic emotions. He saw a business that had the power to raise its prices by 10% every single year, and not a single customer would even consider switching to a competitor over a few cents. This was a revelation. See's Candies required very little capital to operate. It didn't need a billion-dollar factory or a massive research and development budget. It had simple kitchens, retail stores, and a brand that lived in the hearts and minds of its customers. When they wanted to grow, they didn't need to issue billions in new stock or take on crippling debt to build a new plant. They could open a new store with a relatively small investment, and that new store would immediately start generating cash, funded by the profits of the existing stores. The business was a self-funding growth machine. The initial $25 million investment was made, and that investment became the cornerstone of Buffett's education in quality investing. In the years that followed, See's Candies would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little in additional capital investment. That $17 million of goodwill that Buffett was so hesitant to pay for turned out to be the most valuable part of the deal. See's taught him that the real profit, the sustainable, explosive profit, didn't come from the assets you could count. It came from the economic characteristics of the business itself, its ability to generate high returns on the actual, physical capital it needed to operate. This was the birth of his focus on return on tangible capital employed. The lesson was learned. The one free puff from a soggy cigar butt was nothing compared to the lifetime of riches that came from owning an entire box of the finest, most sought-after cigars in the world. This shift from buying cheapness to buying quality required Buffett to overcome a powerful psychological barrier, a cognitive bias that traps most investors in a cycle of mediocrity, the anchoring bias. Our brains are wired to latch onto the first piece of information we receive and use it as an anchor, disproportionately influencing all subsequent decisions. For Buffett, that anchor was the Gospel of Benjamin Graham. His entire early career was anchored to the mathematical certainty of buying assets for 50 cents on the dollar. Concepts like brand value, pricing power, and competitive moats were fuzzy, qualitative, and didn't fit neatly into Graham's rigid formulas. The price-to-book ratio was his hammer, and every company looked like a nail. This is a prison for the mind. Investors today do the same thing. They anchor on a stock's 52-week low, a hot tip from a friend, or a single metric like the PE ratio. They see a stock that has fallen 50% and think, it must be cheap, anchoring on the past price rather than analyzing the deteriorating business fundamentals. They buy a company with a low PE ratio without asking tons why it's low. Often it's low because the company is in a terrible, capital-intensive industry where every dollar of earnings has to be immediately reinvested into new machinery just to stay in business, leaving nothing for the shareholders. Munger's genius was in forcing Buffett to lift his anchor. He presented a new piece of information so compelling that it couldn't be ignored. The idea that the quality of the business is the single most important variable in long-term compounding. This fought against another cognitive trap, the availability heuristic, which is our tendency to overestimate the importance of information that is easily available to us. For investors, the most available information is the stock price and the standard financial metrics plastered all over finance websites. Balance sheets and income statements are readily available. Calculating a price-to-book value is easy. Understanding the durable competitive advantage of a company like See's Candies requires deeper, more qualitative work. It requires thinking like a business owner, not a stock picker. It demands you investigate the relationship between the company and its customers, the structure of its industry, and the long-term sustainability of its profits. The 99% of investors are swayed by what is easily available, the daily stock quote, the news headlines, the simplistic metrics. The master investor overrides this impulse. They do the hard work of understanding the less available, but infinitely more important, information about the underlying business. Buffett's transition from cigar butts to See's Candies was a conscious, effortful act of rewiring his own brain, moving from a system of easy, available, anchored metrics to a more holistic and ultimately more powerful mental model of business valuation. So how can we translate this profound shift into a practical tool? We can build what I call the franchise value filter, a mental model to apply to any potential investment, screening for the qualities that made See's Candies so successful. It's a four-step process. Step 1 is to identify a durable competitive advantage, what Buffett calls a moat. This is the core of franchise value. Does the company possess something that protects it from competition? This could be a powerful brand name that commands customer loyalty and pricing power, like Coca-Cola or Apple. It could be a patent that gives it a temporary monopoly, like a pharmaceutical company. It could be a network effect, where the service becomes more valuable as more people use it, like American Express or Facebook. Or it could be a low-cost advantage, like Geico's direct-to-consumer insurance model. The first question you must always ask is, what is this company's moat, and how durable is it? Step 2 is to ask the crucial question of capital intensity. Does this business need to spend enormous sums of money on property, plants, and equipment just to stay in business and to grow? A great franchise, a capital-light business, does not. Think of Microsoft. To sell another copy of Windows or another Office 365 subscription, their marginal cost is nearly zero. They don't need to build a new factory. Contrast this with a steel company. For it to grow its sales, it must invest hundreds of millions or even billions of dollars in new blast furnaces. That capital is tied up, risky, and may never earn a satisfactory return. You must develop an obsession with identifying businesses that can grow sales without a proportionate growth in their tangible asset base. Step 3 is to test for pricing power. This was the telltale sign at See's Candies. Can the business consistently raise its prices year after year without losing significant market share to its competitors? This is the single greatest test of a great business. If a company has true pricing power, it means its customers are locked in, either through brand loyalty, high switching costs, or a lack of viable alternatives. This power allows the company to offset the effects of inflation and to consistently increase its profitability. If a company's CEO complains about rising input costs and their inability to pass those costs on to consumers, you are very likely looking at a poor business with no moat. Finally, step 4 is to evaluate the skill of management in the art of capital allocation. A great business generates a torrent of cash. What management does with that cash is of paramount importance to you as an owner. Do they reinvest it wisely in high-return projects that expand the moat? Do they return it to shareholders through intelligent share buybacks when the stock is undervalued? Or do they squander it on foolish, empire-building acquisitions that destroy value, a phenomenon Buffett calls diversification? A great jockey on a great horse is an unbeatable combination, but even a great business can be ruined by a management team that makes poor capital allocation decisions. Following this four-step filter forces you to think beyond the simple metrics and to analyze a business as a long-term owner, which is the very essence of the Warren Buffett method. The antithesis to this approach, the path followed by the vast majority of market participants, is the seductive trap of growth at any cost. This mindset is fueled by a constant media narrative that glorifies revenue growth above all else. A company announces its quarterly sales are up 20%, and the stock soars, regardless of how much capital was incinerated to achieve that growth. Investors get swept up in exciting stories about disruptive technologies, new markets, and visionary CEOs, and they completely ignore the economics of the underlying business. Consider a hypothetical, hyped-up electric truck company. It has a charismatic CEO, a sleek prototype, and a story that captures the imagination. Analysts project massive revenue growth for the next decade. Investors pour in, captivated by the narrative. But they fail to ask the critical questions from our franchise value filter. The moat is questionable, with dozens of competitors entering the space. But most importantly, the business is a black hole for capital. To meet its growth projections, it needs to build multiple, multi-billion-dollar factories. It needs to spend billions on research and development. It needs to build out a global supply chain. To fund this, the company constantly issues new stock, diluting the ownership stake of the early investors, and takes on mountains of debt. The revenue line on the income statement goes up, but the value of each individual share of stock goes nowhere, or even down. The growth is unprofitable. It consumes more cash than it generates. This is the path of the 99%. They chase the story, they fall in love with revenue growth, and they end up holding shares in businesses that are magnificent at consuming capital, but terrible at generating it for their owners. They mistake activity for progress and growth for value creation. They buy the sizzle, and only years later realize there was never any stake. The direct financial connection between the See's Candies model and massive wealth creation is one of the most powerful forces in finance. Let's make it tangible. Berkshire Hathaway paid $25 million for See's in 1972. The business at the time was earning about $2 million pre-tax. Crucially, it only required about $8 million in tangible capital, factories, stores, inventory, to generate that profit. Now, let's look at the magic. Because of its brand and pricing power, See's could grow its earnings year after year, but because it was a capital-light business, it did not need to retain those earnings to fund its growth. That cash, that torrent of $2 billion over the decades, could be sent back to headquarters in Omaha. Buffett could then take that cash from the candy business and deploy it into other wonderful businesses, like Coca-Cola, American Express, or Apple. See's Candies became a financial gusher that funded the acquisition of other gushers. This is the key. A capital-light business with high returns on tangible capital provides the fuel for the Berkshire Hathaway compounding engine. Compare this to the alternative. If Buffett had bought a capital-intensive textile mill that earned $2 million a year, almost all of that profit would have had to be reinvested back into the mill to buy new looms and equipment just to fend off competition. That cash would be trapped. It could not be used to buy other businesses. It was dead capital. The difference on a balance sheet and in a portfolio is stark. The See's Candies investment turned $25 million into billions of dollars of deployable cash for its owners. The textile mill investment would have turned millions into, at best, a slightly less dilapidated mill. Understanding this distinction is the first and most critical step towards true financial analysis and intelligent stock picking. To truly weaponize this insight, we need to move from the story to the specific tool itself. We have to deconstruct the metric, this hidden number that Buffett and Munger use to separate the economic castles from the quicksand traps. That metric is Return on Tangible Capital Employed, or ROTCE. Wall Street and the financial media are obsessed with other, more common metrics, primarily return on equity or ROE. ROE is simple to calculate. You take a company's net income and divide it by its shareholders' equity. It seems logical. It tells you how much profit a company is generating for every dollar of equity capital invested. But it has two fatal flaws that can make it dangerously misleading. First, it can be easily manipulated and artificially inflated by using a lot of debt or leverage. A company can borrow massive amounts of money, which reduces its equity base, and suddenly its ROE looks fantastic, even if the underlying business is mediocre. The investor sees a high ROE and thinks they've found a winner, when in reality they've found a highly indebted, risky company. Second, and more critically for our purposes, the equity part of the calculation includes intangible assets and goodwill, those phantom figures on the balance sheet that often arise from overpriced acquisitions. This muddies the waters because it doesn't tell you how well the business is performing with the real physical assets it needs to operate. This is where the anecdote of Buffett's investment in the Washington Post Company in the early 1970s becomes so illuminating. At the time, Wall Street saw the Post as just another newspaper company. They looked at the balance sheet and saw the printing presses, the delivery trucks, and the buildings. They valued it as a collection of tangible, depreciating assets. Its ROE was decent but not spectacular. But Buffett saw something entirely different. He saw that the Washington Post had a functional monopoly on the Washington, D.C. market. It was the dominant source of news, advertising, and classifieds in the nation's capital. This dominance was its true asset, an intangible economic franchise. The printing presses were necessary, yes, but they were a tiny part of the value equation. The real value was in the brand, the reader loyalty, and the indispensability to local advertisers. He realized that the business gushed cash far in excess of what was needed to maintain its tangible asset base. It was a capital-light business hiding in the shell of a capital-intensive industry. By focusing on the earnings the business could generate relative to the tangible capital it actually required, he saw a phenomenal business trading at a ridiculously cheap price. He invested $11 million, which would eventually become worth over $1 billion. He did this by ignoring the standard Wall Street metric of ROE and using his own, more refined lens, a lens that focused only on the return generated by the real, necessary assets of the business. The reason most investors miss these opportunities is due to a powerful cognitive bias known as the framing effect. This principle of behavioral psychology demonstrates that how information is presented or framed can dramatically influence our decisions. Wall Street and the financial media frame the discussion of corporate performance around metrics that are simple, headline-grabbing, and often misleading. Earnings per share (EPS) growth is the star of the show every quarter. It's a single, easily digestible number. Revenue growth is another. Return on equity (ROE) is flashed on screens as the definitive measure of profitability. These frames create a reality for the average investor. They are salient, meaning they are prominent and easily noticeable, and our brains are wired through the salience bias to pay more attention to things that are vivid and easily brought to mind. A headline that screams "Company X beats EPS estimates" is far more salient than a nuanced discussion about the denominator in a return on capital calculation. ROTCE requires you to reframe the entire question. Instead of asking how much did earnings grow, you are forced to ask how much capital did it take to generate that growth. Instead of asking what is the return on the accounting number called equity, you ask what is the return on the actual hard assets this business needs to compete. This reframing is a deliberate act of intellectual effort. It requires you to fight against the easy, available, and salient numbers and dig deeper into the financial statements. The human brain is inherently lazy. It prefers the path of least resistance. Calculating ROE is easy. Calculating ROTCE requires a few extra steps, a bit more thought, and a willingness to challenge the conventional frame. This is why it provides an edge. The majority of market participants are playing the game within the frame provided to them by Wall Street. By choosing to adopt a different frame, the frame of a business owner focused on capital efficiency, you are immediately playing a different, more intelligent game. You are looking for the hidden reality behind the convenient fictions, and that is where the most profound investment opportunities are found. So let's build the blueprint. How do we actually calculate this number? It's a two-part process. First, we need the numerator, the return. Second, we need the denominator, the tangible capital employed. For the numerator, we want a clean measure of the company's operating profitability before the effects of leverage and taxes. The best figure to use is earnings before interest and taxes, or EBIT. You can find this on the company's income statement. We use pre-tax earnings because we want to measure the operational efficiency of the business itself, separate from its tax situation, which can vary for many reasons. We also use pre-interest earnings because we want to see how much profit the assets are generating, regardless of how those assets are financed, either with debt or equity. Now for the denominator, the more complex part, tangible capital employed. This requires a trip to the balance sheet. The goal here is to figure out how much real, physical capital the business needs to operate. We start with total assets. From this, we must first subtract all the intangible assets and goodwill. Goodwill is an accounting plug figure created when one company buys another for more than the book value of its assets. It represents things like brand name or customer relationships, but it's not a physical asset that the company is actively employing. We want to get rid of this accounting fluff. So, total assets minus intangible assets and goodwill. Next, we have to account for the free financing the company gets from its suppliers and customers. These are called non-interest-bearing current liabilities. The most common example is accounts payable. When a company buys inventory from a supplier but has 30 or 60 days to pay for it, that supplier is effectively giving them a short-term interest-free loan. This reduces the amount of capital the company itself has to put up to run the business. So we subtract these non-interest-bearing current liabilities from our asset figure. The final number is our tangible capital employed. It represents the net amount of real, tangible assets, factories, equipment, inventory, that the company had to pay for with its own or its lenders, money to run its operations. The final step is simple division. You take the EBIT, your return, and divide it by the tangible capital employed figure you just calculated. The resulting percentage is the ROTCE. A business that can consistently generate a high ROTCE, say above 20 or 25%, is demonstrating incredible capital efficiency. It's a sign that the business has a strong competitive advantage, a powerful moat that allows it to earn outsized profits on a very small base of real assets. This is the hidden number. It's not handed to you on a platter. It requires a bit of fundamental analysis, a willingness to assemble the pieces yourself. But the insight it provides is the key to unlocking the Warren Buffett method of investing. The antithesis of this disciplined approach is the widespread seduction of return on equity. The 99% of investors, and even a shocking number of professional analysts, use ROE as their primary gauge of a quality business. This is a catastrophic mistake because it ignores the two poisons of financial analysis: leverage and accounting fiction. Let me illustrate with a tale of two companies. Company A is in the business of manufacturing widgets. It's a tough, competitive industry. To stay ahead, it recently spent $5 billion buying a rival. On its balance sheet, $4 billion of that purchase price was recorded as goodwill. It also funded its operations with a huge amount of debt. When you calculate its ROE, it looks amazing, let's say 30%. The net income is high relative to the sliver of equity left on the balance sheet after all the debt and goodwill. Now consider Company B. It's a software company with a dominant niche product. It has very few physical assets, just some office space and servers. It has zero debt. And it has never made a large acquisition, so it has no goodwill on its balance sheet. Its business model is incredibly efficient. Its ROE is also 30%. The average investor looking at a stock screener sees ROE equals 30% for both companies and thinks they are of equal quality. They might even prefer Company A because it's in a real industry and its stock might be more volatile and exciting. But when we apply our ROTCE lens, the truth is revealed. For Company A, the widget maker, its return, EBIT, is generated by a massive base of tangible capital, all those factories and machines. Its ROTCE might only be 8%. It's a terrible business masquerading as a good one through financial engineering. For Company B, the software company, its EBIT is generated by a tiny base of tangible capital. Its ROTCE is astronomical, perhaps 100% or more. This is the truly great business. The ROE figure concealed the risk and poor economics of Company A and understated the magnificent efficiency of Company B. The 99% buy Company A, lured by the high ROE, and wonder why their investment struggles over the long term. The intelligent investor uses ROTCE, identifies the quiet brilliance of Company B, and reaps the rewards of genuine value creation for decades. Let's nail this down by looking at the direct financial connection, a tale of two simplified balance sheets. On one side, we have an airline. Its balance sheet is groaning under the weight of its assets. It lists billions of dollars in airplanes, airport gates, and maintenance facilities. These are its tangible capital. It also carries a colossal amount of debt used to finance these assets. On the other side, we have a dominant brand-name soda company. Its balance sheet is remarkably light. It has some bottling plants and delivery trucks, but its most valuable asset, the brand name and the secret formula, is either not on the balance sheet or is listed for a trivial amount. Now let's run the numbers. The airline might generate, say, $1 billion in EBIT, but its tangible capital employed, after we do our calculation, might be $20 billion. Its ROTCE is a paltry 5%. For every dollar invested in the hard assets of the business, it's earning just 5 cents a year in operating profit. This is a brutal business model. Now look at the soda company. It might also generate $1 billion in EBIT, but its tangible capital employed might be only $2 billion. Its ROTCE is a phenomenal 50%. For every dollar invested in its hard assets, it's earning 50 cents a year. One is a capital-guzzling machine, the other is a cash-generating machine. Yet, due to accounting rules and the use of leverage, their return on equity could look deceptively similar. The ROTCE calculation acts like an X-ray, allowing you to see through the skin of the financial statements and view the true economic skeleton of the business. It reveals which companies are built for flight and which are destined to remain grounded by the immense weight of their own assets. Once you have this X-ray vision, you can begin to spot these capital-light wonders in the wild. Their anatomy is distinct, and understanding it is key to building a portfolio of superior compounders. These are the businesses that possess the deepest moats, the ones that allow them to generate incredible profits without needing to constantly reinvest in expensive physical assets. The quintessential example from Buffett's own portfolio is Moody's Corporation, the credit rating agency. The story of this investment reveals the anatomy of a perfect capital-light business. Moody's, along with Standard & Poor's, forms a powerful duopoly in the business of rating the creditworthiness of bonds issued by corporations and governments. For decades, if you were a company that wanted to borrow money on the public markets, you essentially had to pay Moody's or S&P to give your debt a rating. The value of Moody's business is not in its office buildings or its computers. Its value lies in its reputation and the regulatory requirement for its services. Its brand is a seal of approval that has been built over a century. This is an immense intangible asset. Consider the economics. To grow its revenue, what does Moody's need to do? If 1,000 new companies decide to issue bonds, Moody's doesn't have to build a new billion-dollar factory. It simply has to hire more analysts. The cost of generating an additional dollar of revenue is incredibly low. As a result, the business generates enormous amounts of free cash flow. The profits pour in, and very little of that cash has to be spent on maintaining or upgrading its tangible asset base. This is the dream business model. It has a powerful moat rooted in its brand and the regulatory landscape. It has extreme pricing power because its customers have no other choice. And it is incredibly capital light. Buffett's investment in Moody's was a masterstroke, a direct application of the lessons learned from See's Candies and the Washington Post. He identified a business whose value was almost entirely in its intangible franchise, allowing it to produce spectacular returns on the very small amount of tangible capital it employed. This is the anatomy of a true cash machine, a business model where value creation is detached from the need for physical capital investment. The psychological principle that prevents most investors from finding businesses like Moody's is a combination of two powerful biases: a preference for the new, which we can call neomania, and a failure to appreciate the power of endurance, which is explained by the Lindy effect. The Lindy effect is the idea that for certain non-perishable things, like a technology or an idea, every day they continue to exist increases their future life expectancy. A book that has been in print for 100 years is more likely to be in print 100 years from now than a new bestseller. The business models of companies like Moody's or Coca-Cola are Lindy-proof. Their moats, based on reputation, brand, and established networks, have survived for decades, even centuries. They have proven their durability. Yet, many investors suffer from neomania. They are constantly chasing the next new thing, the disruptive technology, the future of everything. Their portfolios are filled with money-losing electric vehicle startups, speculative biotech companies, and software firms with trendy buzzwords but no profits. They are drawn to novelty and excitement. This is a deep-seated human trait. Our brains are wired to pay attention to changes in our environment. A new threat or a new opportunity requires our immediate focus. The old, stable, and predictable fades into the background. In the investment world, this is a fatal flaw. The boring, predictable, Lindy-proof business like a credit rating agency or a candy company doesn't generate exciting headlines. It doesn't offer the thrill of a 10-bagger in a week, and so it gets ignored. Investors seek confirmation for their belief that, quote, "this time it's different," falling prey to confirmation bias. They look for data that supports their investment in a new, unproven technology, while ignoring the mountain of evidence that shows how few of these companies ever generate sustainable profits. The wise investor actively fights this urge. They understand that in business, as in many things, what is old and has survived is often superior to what is new and untested. They appreciate the Lindy effect and actively seek out businesses with enduring moats, the very businesses that are most likely to be capital-light wonders. To systematize this search, we can use an economic moat checklist, a practical mental model for identifying the sources of a high and sustainable return on tangible capital employed. This checklist is divided into 4 main categories. The first is intangible assets. This is where you look for brands, patents, and regulatory licenses. Does the company have a brand so powerful it can charge a premium price for a product that is otherwise a commodity? Think of Tiffany & Company selling jewelry or Starbucks selling coffee. Does it have a patent that protects its product from competition, like a blockbuster drug from a pharmaceutical giant? Does it have a government license that limits competition, like a utility or a broadcast network? These intangible assets allow a company to generate profits without a corresponding investment in physical stuff. The second category is switching costs. How difficult or expensive is it for a customer to switch from this company's product or service to a competitor's? Think about your bank. Moving all your automated payments, direct deposits, and financial history to a new bank is a massive headache. Those high switching costs lock you in as a customer, allowing the bank to earn a steady profit from you. Enterprise software companies like Oracle or SAP are masters of this. Once a large corporation has built its entire operations around their software, the cost and risk of switching to a new system are astronomical. High switching costs create a sticky customer base and a very durable moat. The third source of a moat is the network effect. This occurs when a product or service becomes more valuable to each user as more people use it. The classic examples are credit cards like Visa and American Express. The more merchants that accept Visa, the more valuable it is for consumers to have a Visa card. And the more consumers who have a Visa card, the more essential it is for merchants to accept it. It's a virtuous cycle that creates a nearly impenetrable moat. Social media platforms like Facebook and marketplaces like eBay also benefit from powerful network effects. The fourth and final category is a cost advantage. This is when a company can produce its goods or services at a structurally lower cost than its competitors. This might come from immense scale, like Walmart's ability to negotiate lower prices from suppliers due to its massive purchasing volume. It might come from a unique process, like Dell's old direct-to-consumer model for building PCs. Or it might come from access to a unique asset, like a mining company that owns a particularly rich ore deposit. A sustainable cost advantage allows a company to either undercut its rivals on price or to earn higher profit margins. By systematically going through this checklist and looking for evidence of one or more of these moat sources in a company's financial reports and business strategy, you can identify the businesses that have the structural characteristics required to produce a high ROTCE year after year. The path of the 99% is the polar opposite. They don't use a checklist, they chase a story. They are addicted to the narrative of technological revolution, and they invest in these stories blindly. They see a future filled with self-driving cars, personalized medicine, and trips to Mars, and they want a piece of the action. They pour their hard-earned money into companies that are promising to build this future, completely ignoring the brutal economics of these endeavors. Let's take a biotechnology firm with a promising new drug in early-stage trials. The story is compelling. It could cure a terrible disease and make billions. But the reality is that the company must spend hundreds of millions of dollars on research, development, and clinical trials over a decade, with a success rate that is terrifyingly low. It is a business that is structurally designed to burn cash. Even if the drug is successful, the company might then have to spend another fortune building a specialized manufacturing facility and a sales force to market it. The capital requirements are immense, and the outcome is uncertain. This is the antithesis of a capital-light wonder. The 99% are essentially buying lottery tickets. They are betting on a low-probability, high-payout event. A few might win big, and those winners are celebrated in the media, creating a powerful survivorship bias that lures in the next wave of hopefuls. But the vast majority of these capital-intensive, story-driven investments end up incinerating shareholder capital. The intelligent investor understands the difference between a speculation on a future technology and an investment in a durable, cash-producing business. They might admire the technological progress from the sidelines, but they will only commit their capital to businesses that have already proven their economic merit, businesses that possess a moat and exhibit the capital-light anatomy we have discussed. They choose the certainty of a cash gusher over the speculative promise of a technological miracle. The direct financial connection between this anatomy and your portfolio growth is through the concept of free cash flow, which Buffett famously retermed owner earnings. This is the concept that ties everything together. Free cash flow is the lifeblood of a business, the cash left over after all expenses and necessary capital expenditures have been paid. Let's create a simple waterfall diagram in our minds. We start at the top with a company's net income. From there, we add back any non-cash charges, like depreciation and amortization. This gives us our operating cash flow. This is the amount of cash the business's operations generated in a year. But we're not done. Now comes the most important step. We must subtract the money the company had to spend on capital expenditures, or CapEx. This is the money spent on buying, maintaining, or upgrading physical assets like buildings and machinery. Here is where the anatomy of a capital-light wonder shows its power. For a business like Moody's or See's Candies, the CapEx number is tiny. They don't have a lot of physical assets, and those they have don't require constant, expensive upgrades. So, from their large pool of operating cash flow, only a small trickle is diverted to CapEx. The result is a massive river of free cash flow gushing out the bottom. This is the cash that truly belongs to the owners. It can be used to pay dividends, buy back stock, or make acquisitions, all without straining the business. Now consider a capital-intensive beast, like an airline or a semiconductor manufacturer. They might also generate a large amount of operating cash flow, but their CapEx number is enormous. They have to constantly spend billions on new airplanes or new fabrication plants just to stay competitive. A huge portion, sometimes all, of their operating cash flow is immediately consumed by CapEx. The river of free cash flow at the bottom is reduced to a tiny, unreliable stream, or sometimes it's even negative. This business is on a treadmill. It runs faster and faster, but it never actually moves forward for its owners. By focusing your investment strategy on businesses that are anatomically designed to maximize the conversion of operating cash flow into free cash flow, you are directly aligning yourself with the companies that have the greatest capacity to reward their shareholders over the long term. Of course, to understand the light, we must also understand the darkness. We must study the anatomy of the businesses that fail this test. The capital-intensive traps that look profitable on the surface but are actually designed to destroy shareholder wealth over time. There is no better teacher on this subject than Warren Buffett's own greatest investment mistake, his original sin, the purchase of Berkshire Hathaway itself. The story begins in the mid-1960s. Buffett, still deeply entrenched in his cigar butt methodology, began buying shares in a struggling New England textile manufacturer called Berkshire Hathaway. It was statistically cheap. The stock was trading for less than the company's working capital. It was a classic Ben Graham play. He eventually took control of the company, intending to use its cash flow to invest in other businesses. But he soon learned a brutal and unforgettable lesson about the horrors of a bad business. The American textile industry was in a terminal decline, facing relentless, low-cost competition from overseas. To have even a sliver of a chance of competing, the Berkshire mills required constant and expensive upgrades. The looms were always becoming obsolete. New technology was always emerging that promised slightly better efficiency. Every dollar the business managed to earn in profit had to be immediately plowed back into new machinery just to keep its head above water. In his 1985 letter to shareholders, Buffett described it perfectly. He said the business had to keep spending more and more money just to run in the same place. It was a capital-intensive nightmare. The business was earning a profit, on paper, but it produced no free cash. The profits were an illusion, immediately consumed by the voracious appetite of the machinery. It took Buffett nearly 20 years to finally admit defeat and shut down the textile operations for good. He later called the decision to buy Berkshire Hathaway a $200 billion mistake, because for 2 decades he funneled capital from his other better investments into trying to save the unsavable textile mill, capital that could have been compounding at a much higher rate elsewhere. This painful 2-decade-long ordeal was his PhD in business economics. It taught him that the quality of the business you buy is paramount. It's far better to pay a fair price for a business that gushes cash than to get a bargain price on a business that consumes it. The psychological trap that kept a genius like Buffett pouring money into a dying business for so long is one of the most powerful and insidious biases we face, the sunk cost fallacy. This is our tendency to continue with an endeavor not because it makes rational sense, but because we have already invested a significant amount of time, effort, or money into it. These prior investments are sunk, they are gone and can never be recovered. Rationally, they should have no bearing on our future decisions, but emotionally they weigh on us like an anchor. We think, I've already put so much into this, I can't quit now. We see this in investors who refuse to sell a losing stock. They average down, buying more of a bad investment in the hopes of making back their initial loss. They are throwing good money after bad, driven by an emotional need to justify their original decision. This is often coupled with the commitment and consistency bias, our deep psychological need to appear consistent with our past actions and beliefs. Once we have made a decision or taken a stand, we face personal and interpersonal pressure to behave consistently with that commitment. For Buffett, he had committed to saving the textile mill. He was the CEO. His reputation was on the line. To shut it down would be to admit failure, to be inconsistent with his prior actions. This cognitive 1-2 punch is what traps investors in bad positions for years, even decades. They hold on to losing stocks in terrible industries because they can't emotionally divest from their past decisions. The ability to recognize a mistake, to brutally and unemotionally admit you were wrong, and to sell a bad investment regardless of what you paid for it, is a superpower in finance. It's a lesson Buffett learned at a cost of hundreds of billions in opportunity cost, a lesson he would never forget. To avoid falling into this trap yourself, you need a practical tool, a mental model, to differentiate between good and bad capital expenditures. This is the capital maintenance versus growth CapEx test. It's a crucial distinction that most investors never make. Not all CapEx is created equal. Maintenance CapEx is the amount of money a company must spend each year just to maintain its current level of operations. It's the cost of replacing worn-out machines, upgrading outdated software, and keeping the lights on. For a business like the Berkshire textile mill, this number was huge. In a good business, maintenance CapEx is very low. Growth CapEx, on the other hand, is discretionary spending on projects that are expected to grow the company's future earnings. This could be building a new factory to enter a new market, or investing in a new product line. Here's how you can apply the test. First, go to a company's annual report, the 10K. In the Management Discussion and Analysis section, management will often break down their capital expenditures, giving you a clue as to how much is for maintenance versus growth. A simple rule of thumb you can also use is to compare a company's total CapEx figure from the cash flow statement to its depreciation expense from the income statement. In a stable business, if CapEx is consistently higher than depreciation, it's a red flag that the company is on a treadmill, having to spend more and more just to stand still. A truly great business will have very low maintenance CapEx, often less than its depreciation charge. This means it has a large amount of free cash flow that it can choose to deploy into high-return growth projects. It is the master of its own destiny. A bad business is a slave to its assets, forced to spend every dollar it earns just to maintain them. By learning to distinguish between these two types of capital spending, you can identify the capital-intensive traps before they drain your portfolio. The antithesis to this deep analysis is the psychological comfort that many investors derive from the glamour of hard assets. There's a tangible, reassuring feeling in owning a piece of a company with massive, physical infrastructure. You can see the airplanes, the factories, the oil rigs, the real estate. It feels real, solid, and substantial. They mistake this physical presence for a good investment. They don't realize that these hard assets are often liabilities in disguise. An airplane is a multi-million-dollar depreciating asset that requires constant, expensive maintenance and will be obsolete in 20 years. A factory is a money pit that needs constant upgrades and is vulnerable to foreign competition. These investors see assets on the balance sheet and think it represents a floor on the stock's value. What they fail to understand is that the value of an asset is not what it costs, but what it can earn. If a billion-dollar factory can only earn a paltry return, it's not a billion-dollar asset from a shareholder's perspective, it's a billion-dollar boat anchor. The capital-light wonders, on the other hand, often have balance sheets that look deceptively light. Their value isn't in physical things, but in intangible moats. This requires a level of abstract thinking that makes some investors uncomfortable. They would rather own a struggling railroad with billions in track and locomotives than a fantastically profitable software company whose only assets are its code and its brand. This bias towards the tangible and the physical is a fundamental error that leads investors directly into the capital-intensive traps that Buffett learned to avoid. They are buying the illusion of security offered by hard assets, while ignoring the beautiful, cash-gushing economics of businesses built on ideas, brands, and networks. Let's quantify this destructive power with the value destruction equation. This is the direct financial connection that explains how growth can actually make shareholders poorer. The equation is simple. If a company's return on the capital it invests is * less than its cost of capital, then every dollar it invests in growth destroys value. A company's cost of capital is the blended rate it has to pay to its lenders, debt, and its owners, equity, for the use of their money. Let's say a typical airline has a weighted average cost of capital, or WACC, of 8%. This is the minimum return it must earn on its investments to not destroy value. Now, let's say this airline decides to grow. It spends $5 billion on a fleet of new, more fuel-efficient airplanes. Management proudly announces this expansion plan, and analysts cheer the growth, but the airline industry is brutally competitive. After all the costs are factored in, the return the airline earns on that $5 billion investment is only 5%. They have invested capital at 5% that cost them 8%. They have a negative 3% spread. That $5 billion growth project has just incinerated $150 million of shareholder value in the first year alone. This is the capital-intensive trap in action. The company is getting bigger, its revenues are growing, but its owners are getting poorer with every new plane it buys. A high ROTCE business, by definition, earns a return far in excess of its cost of capital. When it invests $1 in growth, it might earn a 30% return on a capital base that cost it 8%. That single dollar of investment creates 22 cents of new value for its owners. One business model creates wealth, the other destroys it. Your mission as an investor is to find the former and ruthlessly avoid the latter. This brings us to the final and most powerful pillar of this philosophy. Understanding ROTCE allows you to identify the great businesses, but the true magic, the explosive growth of wealth, happens when these great businesses are paired with intelligent capital allocation. This is how the ROTCE metric fuels the flywheel of wealth, creating a compounding engine that can turn a modest investment into a fortune over time. There is no better modern example of this than Warren Buffett's investment in Apple. By the time Buffett started buying Apple in 2016, it was already the largest company in the world. Many thought its high-growth days were over, but Buffett saw something different. He didn't see a technology company. He saw a consumer products company with the most valuable brand in the world and an ecosystem that created astronomical switching costs for its customers. He saw a business with a sky-high return on tangible capital. But the real key to his investment thesis was what Apple was doing with the tsunami of cash it generated. The company was producing so much free cash flow that it couldn't possibly reinvest it all back into its own business at similarly high rates of return. So under the leadership of Tim Cook, a master of capital allocation, Apple began to return that capital to its owners in the most efficient way possible: massive share buybacks. From 2016 to today, Apple has spent hundreds of billions of dollars buying back its own stock. Buffett loves this. Why? Because when a fantastically profitable company with a high ROTCE buys back its own shares, it is effectively reinvesting its capital in its own phenomenal business. Each share that is repurchased makes the remaining shares more valuable. It increases each shareholder's percentage ownership of the company and their claim on its future earnings. Buffett bought a huge stake in Apple, and then he sat back and watched as Tim Cook used the company's own cash to make Buffett's stake even bigger and more valuable every single year. This is the compounding engine in its most potent form, a capital-light wonder, generating more cash than it needs, and intelligently returning that cash to shareholders, supercharging their returns. The psychological hurdle that prevents most people from benefiting from this incredible force is their inability to grasp exponential growth and their craving for instant gratification. Our brains evolved in a world that was primarily linear. If you walk for an hour, you cover a certain distance. If you walk for 2 hours, you cover twice that distance. But compounding doesn't work that way. It's exponential. A business with a high ROTCE that reinvests its earnings is like a snowball rolling down a very long, snowy hill. In the beginning, it's small, and its growth is barely perceptible. This is where most investors lose patience. They see their stock go up a few percent and they sell, eager to lock in a small gain. They are demanding immediate gratification. They are eating the marshmallow. But the investors who have the psychological fortitude to delay gratification, to let that snowball roll for 10, 20, or 30 years, are the ones who end up with a boulder of wealth at the bottom of the hill. The most powerful effects of compounding are back-end loaded. The real magic happens in the later years. This is why Buffett says his favorite holding period is forever. He understands that the key to harnessing the power of the compounding engine is to give it the one thing it needs most: time. The exponential growth bias makes us underestimate the long-term power of a high-quality business, and our need for immediate gratification makes us sell it far too early. To ensure you are investing in a company that will fuel this engine, you need a final mental model: the shareholder-friendly capital allocation scorecard. Once you've identified a high ROTCE business, you must assess how management uses the free cash flow it generates. There is a clear hierarchy of choices. The best option, option A, is for the company to have abundant opportunities to reinvest its cash back into its core business at similarly high rates of return. This is a business that can compound its own value internally. This is the ideal scenario for a long-term owner. If those opportunities don't exist, the next best choice, option B, is for management to intelligently buy back its own shares, especially when the stock is trading at a reasonable or undervalued price. This is what Apple does, and it directly increases your ownership stake and future returns. The third choice, option C, is to pay a dividend. This is a good way to return cash to shareholders, but it is generally less efficient than a buyback from a tax perspective and less powerful from a compounding perspective, as it takes the capital out of the high-return business and puts it into your hands, where you might not have as good a place to invest it. The worst choice, and the one that destroys the most value, is option D, making dumb, overpriced, or strategically incoherent acquisitions. This is often driven by management ego and a desire to build a bigger empire, not a more profitable one. Your job as an analyst is to read the company's reports, listen to its conference calls, and grade the management team on their capital allocation decisions. Are they consistently choosing options A and B, or are they squandering your cash on C and D? A great business with a terrible capital allocator at the helm is a frustrating and often unrewarding investment. A great business with a great capital allocator is the key to building generational wealth. The most common mistake made by the 99%, the antithesis of this scorecard, is an obsession with dividends. Many investors, especially those nearing retirement, build their entire investment strategy around chasing high dividend yields. They see a 5% or 6% yield, and they are immediately drawn in, seeing it as a source of steady, quote, income. What they fail to realize is that a high dividend yield can often be a major red flag. It can be a signal that the company is in a slow growth or declining industry and has no profitable opportunities to reinvest its earnings. They are choosing a small, certain payout today over the potential for massive capital appreciation tomorrow. Consider Amazon. For decades, it paid no dividend. An income-focused investor would have never touched it. Why? Because every single dollar of profit Jeff Bezos could get his hands on was immediately reinvested back into the business, into building new fulfillment centers, developing Amazon Web Services, creating the Kindle. These were all reinvestment opportunities with phenomenally high rates of return. By retaining and reinvesting those earnings, Amazon was able to compound its intrinsic value at an astonishing rate, creating far more wealth for its long-term shareholders than any dividend-paying utility stock could have ever hoped to. The 99% are focused on harvesting the fruit from the tree, while the intelligent investor is focused on owning the orchard that grows bigger and more productive every single year. The direct financial connection that powers this entire compounding engine is the concept of owner earnings. This is Buffett's term for free cash flow, and it represents the true bottom line for you as a shareholder. The entire chain of logic we have built comes together here. A business with a strong moat is able to generate a high return on tangible capital employed. A high ROTCE means the business is capital light and does not require large capital expenditures to maintain itself. Low maintenance CapEx means that a very high percentage of the company's operating cash flow is converted into owner earnings. These owner earnings are the fuel for the intelligent capital allocation choices we just discussed. They can be reinvested at high rates, used to buy back shares, or paid out as dividends. Let's visualize the 20-year impact. Company A has a respectable 10% ROTCE. It pays out most of its earnings as dividends. Its value grows slowly, mostly in line with inflation. Company B has a phenomenal 25% ROTCE. It retains all of its earnings and reinvests them back into the business at that same high rate. For the first few years, the difference in performance might not seem dramatic, but as the power of compounding takes hold, the value of Company B begins to grow exponentially. By year 20, Company B is not just 2 or 3 times more valuable than Company A, it is 10, 20, or even 50 times more valuable. Its intrinsic value has followed the explosive upward curve of exponential growth. This is the ultimate goal. This is how you use the hidden number of ROTCE, not just to find good companies, but to find the compounding machines that can carry you to true and lasting financial freedom. You have just been given a powerful new weapon for your financial toolkit. This is more than just a metric. It is a complete mental model for viewing the world of business. You now possess a lens that allows you to pierce through the noise of Wall Street, to look past the misleading headlines and the seductive but flawed metrics that trap the majority of investors. You can now distinguish between a business that is built to consume cash and one that is engineered to produce it. You have the framework to identify the capital-light wonders with durable moats and to appreciate the explosive power of the compounding engine they fuel. This is an incredible advantage, a piece of the intellectual arsenal used by the world's greatest investor. But it is crucial to understand that what you have just mastered is one vital piece of a much larger, interconnected system. Identifying a great business using return on tangible capital employed is the first essential step. It is the act of finding the perfect racehorse. However, the system for achieving superior returns also requires knowing what price to pay for that horse and how to construct a stable of such horses that can weather any storm the market throws at it. The analysis you've learned today tells you what horse to buy. The next piece of the map, the critical link that connects this knowledge to real-world portfolio growth, is the discipline of valuation and portfolio management. The video that is now on your screen is designed to be that next piece. It is the bridge from being a great business analyst to becoming a great investor. It addresses the questions that logically follow from today's journey. This is the choice every student faces. Do you settle for mastering a single concept, or do you commit to completing the entire intellectual framework? The click you are about to make is not just about watching another video. It is a declaration about the kind of investor you choose to become. Will you be someone who knows a few tricks, or will you be someone who masters the entire craft? The path to becoming a truly intelligent investor, a capital allocator in command of your own financial destiny, continues from here. Complete your arsenal, click, and continue your ascent.